Hello, everyone, and welcome to another video from Three Counties. Today, I have the huge pleasure in talking to David Zahn, Head of European Fixed Income and Senior Vice President within Franklin Templeton's Fixed Income Group. But before we begin, please show your appreciation for the channel by pressing the subscribe button below. So here, I think. Leave a like by hitting the thumbs up button and perhaps even leave a comment and make it a good one. So, David, thanks once again for giving us your time. Really appreciate it. Kicking things off, during the pandemic, the majority of focus has been on equities. How's the fixed income market fared?
Yeah, I think the fixed income market was very similar to what we experienced in equities, in that when we had that big drawdown back in March, we saw that we had the risk off went on in bonds as well as equities, and credit widened, high yield sold off. Things like gilts and treasuries and boons all rallied because people were like, okay, well, there is something wrong. And then once we started to see the central bank response, which we all knew was coming, it was just how quickly was that going to come, really kicked off by the Fed. They're just going to start buying a lot of fixed income to help create liquidity in the market, followed up by the ECB and the MPC. You saw that these markets came back. And so, we can make a lot of money in fixed income with volatility. And so by shifting out of less risky assets or cash, because we entered the year with quite a bit of cash, into corporates, we actually were able to get quite a good return last year from the rebound. And since then, we've seen that risk on or riskier assets in fixed income have continued to do well. You've seen that credit spreads have tightened in corporates, IG, and high yield. We've seen that within Europe. One of the big areas of focus has been the spread of peripheral government bonds versus the core government bonds. So you've really seen this huge compression of fixed income assets onto the risk-free. Mm-hmm. And now we're sitting here with rates relatively low in most places, UK, included. And the next question is, what's next? What's going to happen? And I think that a lot of people are talking about we're going to have inflation. Now, I think that there will be some inflation in some countries, but inflation tends to be more regional rather than a global inflation. Yeah. And so in Europe, no chance of inflation in the near future. The ECB's own forecast for 3 years is 1.3. So it's, they see inflation coming back, but not getting close to their target. In the UK, we probably will see a little bit of inflation, but that's probably more due to the disruptions over Brexit, and that will be very much in certain imported goods, and then that will calm down. And the US, we do expect that we will see a little bit of inflation kind of into the middle of the year. But it's difficult to see where we're going to find really durable inflation from, that you're going to go, okay, inflation is just going to keep going and going. Mm-hmm. And so we think fixed income will probably stay around these levels for a while. Mm-hmm. Until we kind of see the economies start to recover. And it really is that recovery that's going to be key in all countries, because we see where the equity markets are, and we see where the fixed income markets are, and then we see where the economy is. And they're not at the same place, and we need to see those two kind of meet. And it should be, because with all the fiscal stimulus and monetary stimulus, so the economy will come back once we get out of COVID. But we do need to see that, and that may in different countries take years. Yeah. In Europe, I would expect it to be several years, UK several years before we kind of get back to that level. Mm-hmm. So in that environment, central banks will continue to be very accommodative. They won't want to pull away too early because they've seen what happens if they do that. And so I think rates will remain quite low.
Yeah, we've seen a recent steepening in the yield curve in the States, and then obviously a bit of a retraction over recent weeks. Do you think this will spread globally, or do you think it's just going to be concentrated within the States?
Well, it's interesting because obviously money is fungible. It goes wherever it wants in the world to find investments. And you've seen that Japan has been doing yield curve control for quite some time and keeping the long end of yields lower. We've seen that in Europe, they're kind of attempting to do similar things through their PEP program. and by keeping yields low. And so yes, you might see some steepening in some yield curves, but then investors just go, well, I can get so much better yield by going there. And hedging costs are relatively low now. I mean, because basically yields are pretty much zero in most developed countries. So to buy a bond and then hedge it back into your base currency doesn't really cost that much. And so I think that you will see some volatility, but I don't all of a sudden see that you'll see big bear steepeners.
Yeah, it seems like the opportunities there. Obviously, if you have a global approach, to be able to take advantage of those potentials within carry trades. I suppose the question that I'm most interested in, and perhaps the viewers, is where are the opportunities within fixed income moving into this post-vaccine world?
Yeah, well, I think that we have a lot of potential risks in this post-vaccine world. I think people are kind of thinking, we all get vaccinated, then everything's okay. Yeah. And I think that there are, and obviously that's a great step forward. I'm not trying to diminish that at all, but there are a lot of potential policy mistakes that could happen as we exit, be it by central banks raising rates, when they don't, they do it too early, by governments cutting off spending too quickly, raising taxes to pay for all of this, spending they've done over the last 12 months, 18 months. And so I do think there are risks to that. And so that's why I think fixed income is still, a good part of your portfolio, because it will help balance out some of the other parts that are a bit more risky. And so I think from that perspective, we really need to focus on what are the risks going forward.
Mm-hmm. Are there any particular regions that you feel are more beneficial at this point in time?
Yeah. So the areas where we feel that there's some good value are emerging markets. We do think emerging markets offer value, but you have to be very selective. So you kind of need to have an active manager to do that. I think in general, I obviously am an active manager, so I believe that we're entering into a time period where active management should do really well, just because, if you do get any move in rates, being able to make changes, it can change quite significantly. And so I think from that perspective, we can add a lot of value. We're also in high yield and the high quality high yield in some of our accounts. We really like that area just because you have, double Bs. Some people won't go down and buy them, but yet the amount of additional yield you get in double Bs compared to triple Bs is quite substantial. And so it's a way to get some extra carry in your portfolio. But I also think you want to have some defensiveness too. So we, in our European and UK accounts, we do have some longer duration fixed income bonds, which we don't actually expect to make a lot of money off of, but it helps balance the portfolio when you get these days where there's risk off, credit is selling off, equities are selling off, those bonds do well. And so I think it is kind of building that portfolio that is has resilience. And I think the other big trends that people really need to focus on, and it's starting to happen more in the UK, but it's happening much quicker in Europe, is the sustainability of your fixed income. And I think that, and green bonds, and we're seeing huge demand into those areas. And I think that would kind of, you'll see more and more flow into that. And so assets that are focused on sustainability should do better going forward. And so I think that's a major trend within fixed income as well as the broader financial markets.
Yeah, no, that's fantastic, David. Thanks very much. I think the takeaway for me is you need to be active. You can't just rely upon yield movements. You need to make sure that the manager is in place who's got the toolkit to be able to look at different opportunities, because it doesn't feel like it's all binary. It's distributed across various different regions. Thanks very much for your time, David. It's been an absolute pleasure. Stay safe. Hope you keep well, and I'm sure we'll catch up soon.
All right. Thank you very much.